In the year 1179, a pope made a decision that would shape the next 1,000 years of human civilization. Not about war, not about land, but about something you almost certainly use today, without ever thinking about where it came from: interest. He called it a mortal sin, a crime against God, something that could damn your soul for eternity. Anyone caught charging it could be excommunicated, cut off from the church, denied burial, refused salvation. And yet today, interest runs the entire world. It decides what you can afford, what governments can build, whether businesses rise or collapse, whether nations survive or default. So how did something once considered one of the greatest evils in human society become the invisible skeleton of modern civilization? And, more importantly, is it actually fair? Because once you understand where this came from, you will never look at money the same way again. Long before banks existed, before coins, before written stories or laws or maps, humans were already in debt. The oldest written records ever discovered, clay tablets from the Sumerian city of Uruk, dating to around 3000 BCE, are not myths. They are not prayers. They are not poetry. They are debt records. In ancient Mesopotamia, the great temples functioned as the banks of their world. Farmers brought grain at harvest. The temple stored it, distributed it during famine, and lent it to those who needed seed for the next planting season. But they did not lend it for free. It was not invented out of greed. It was invented for survival. Think about it this way. A farmer borrows grain in spring. If he only returns the same amount in autumn, the temple's reserves slowly shrink with every bad harvest, every drought, every war. Within a generation, nothing is left. The entire system collapses. So they added a percentage, not to exploit, but to sustain the institution across time. This is what the Code of Hammurabi, carved in stone around 1754 BCE, made official. 33% on grain loans, 20% on silver. These are the first interest rates ever recorded by human hands, and they are shockingly high, even by modern standards. The Greeks called interest tokos, meaning offspring, the idea that money, like a living thing, could reproduce itself. The Romans built entire financial empires on it. Julius Caesar himself borrowed enormous sums and used political power to escape repaying them. For 3,000 years, across every civilization on Earth, interest was practical, accepted, necessary. When the Western Roman Empire fell in 476 AD, it did not just leave a political vacuum, it left an economic one. Into that vacuum stepped the Catholic Church, and with it came a completely new moral framework for money. It drew on three sources: Aristotle, who argued money is barren by nature, it cannot breed; Old Testament passages forbidding interest among fellow Israelites; and Luke's Gospel, lend, expecting nothing in return. Usury, the charging of any interest, was a sin against nature, against Scripture, and against God. Because they saw something real and dangerous. Interest concentrates wealth. The rich lend, the poor borrow, and over time, the gap between them doesn't just grow, it explodes. Under Pope Alexander III in 1179, the decree became absolute: charge interest, any interest, and you could be excommunicated, denied burial, cut off from salvation. Think about what that meant in the medieval world. To die a usurer was to die outside the church, and to die outside the church was, in the medieval mind, to be damned. Medieval theology carved out one exception to the prohibition: Jews. Jewish communities became economically essential. Kings needed credit for wars. Nobles needed loans for bad harvests. But they were also despised for providing the very service everyone required. The church had created a system that needed moneylenders to function, and then condemned those who did the lending. But here is the twist. Even with eternal damnation on the line, the economy still needed credit. So people didn't stop lending. They adapted. In the city-states of northern Italy, Christian merchants invented workarounds so sophisticated they would reshape the entire financial world. The bill of exchange: a merchant gives money to a banker, not as a loan, but as a currency exchange. The difference in exchange rates, by a convenient coincidence, always seems to benefit the banker. It was interest, dressed in different clothes. No family mastered these structures more completely than the Medici of Florence. Founded in 1397, the Medici Bank became the largest financial institution in Europe within a generation. It financed popes, it funded wars, it bankrolled the Renaissance itself. And officially, they never charged interest. The church's prohibition had not stopped credit, it had made credit more sophisticated. That someone was John Calvin. In 1536, the Protestant reformer argued that the biblical prohibition on usury applied to a specific context, exploiting the poor, not to commercial lending between merchants. Moderate interest was not sinful, it was productive. England legalized interest in 1545. The Netherlands followed, then the rest of Europe. The system that had been hidden for 300 years became official, and what happened next changed the world faster than almost anything before it. The Dutch Republic, one of the first nations to fully embrace low-interest credit markets, became the wealthiest nation on earth per capita in the 17th century. No vast resources, no large army, just access to cheap capital. Britain's Industrial Revolution was not built from savings. It was built from borrowed capital. Every mill, every mine, every railway financed by interest-bearing debt. Interest is not a feature of the modern economy, it is its skeleton. Today, it surrounds you completely. Your mortgage, your credit card, your student loan, your government's ability to build roads, fund hospitals, pay soldiers. The same problems the church was trying to prevent, they never went away. Payday loans in modern America charge annual rates above 400%. Millions of people trapped in debt cycles that medieval peasants would have recognized immediately. Even today, Islamic finance, serving over 1 billion people, still prohibits riba, the Arabic word for usury, and has built an entire parallel banking architecture around that prohibition. The exact same workarounds the Medici invented in 15th century Florence, Islamic finance independently rebuilt in the 20th century. The debate is not over, it is just quieter. 5,000 years ago, a farmer borrowed grain and paid back more. 1,000 years ago, a church declared that act a mortal sin. 500 years ago, a reformer declared it a necessity. And today, the interest rate set by central bankers in Washington, Frankfurt, and Beijing moves the price of everything you own, everything you owe, and everything your government can afford to do. But here is the real question, the one that has never been answered. Who invented interest? Everyone. The question that matters is who it serves and who pays the price. If this changed how you see money, subscribe to Imperium Economica. Because history doesn't just explain the past, it explains the world you're living in right now.